Well, good Monday, everybody. Happy to be here with you. I'm Connie Hill. Happy you joined me here for our Straddles and Strangles webcast. This is a strategy that maybe we don't talk about a lot, but really has a lot of use, especially when we're in earnings season, which we've been in the thick of. I'm really happy how our last couple of trades turned out because they are going to give us some fantastic trade management content to talk about in terms of how those different trades went. So if you're paper trading along with me on the example trades, hopefully you have some questions. Feel free to bring those up. I am joined in the chat by Brent Moore. So glad Brent's here. He's a fellow coach and friend, and he teaches the advanced options webcast that maybe picks up some of these other multi-leg option strategies. And Brent, I can't remember which day you do that. Is that Thursday or Wednesday? Go ahead, put a note in the chat so people know when to find you in that class. I hope you're following me on X. I'm Connie Hill CS. Brent is Brent Moore CS. We'll post educational content out in our X account, things that we notice about the market that we think you might like, or that we think are informative. We're going to share that information with you. So it's free, follow along. Love to have you. Let's go through our disclosures and then lay out our agenda for today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for education and informational purposes only. Don't consider it a recommendation. With long options, which straddles and strangles are when they're long, you could lose 100% of your funds invested. We will be using the Paper Money software application. It's for educational use, educational purposes, but it's a fantastic tool, especially as you're doing some of these example trades along with me in your paper account. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results. Now, I'm just curious, out here in the chat, how many of you followed along with our Roblox and our Roku trades from last week? I'm just curious, let me know. Want to just let you guys know of the 3 final events, workshop events for the year: Anaheim, Houston, Miami. I think it's great they didn't pick Buffalo, Toronto, during December. I mean, they're probably great places to go to, right? But nice sunny spots. You can get there easily. You will be happy that you took time to go to these events. All right. Thank you, Brent. Brent posted that playlist out in the chat. We're going to take a look at what happened to Roblox and Roku. There are 2 trades that we put on last week, and they turned out for fabulous discussion. So if you have questions about those trades in particular, feel free to chat them in. I'll keep my eye on the chat. Brett will keep his eye on the chat as well, because there might be some things that I can't quite get to that he'll answer for you guys, okay? Let's head over to Thinkorswim. And let's see, the market's a little bit flat, I guess, on the S&P, up barely, just a notch, 0.04% right now. We can see on this candle, kind of pulling back from where it started here this morning. However, is our uptrend still intact? Oh, you bet it is, right? New high here was on the 29th, which I think was Wednesday. So new high here, and it keeps making this, right? The blue line's a 10-period moving average. The red line is the 30-period moving average. And so you can see, yeah, the SPX has stayed for the most part well above that 30-period moving average. We had some time down here a little bit below it, but recovering pretty quickly. I'm going to keep our implied volatility on here as we look at some different trades, because it's interesting to see what happens with that implied volatility. Is really pertinent to our example trades that we do here. Oh, Kevin says he didn't. I was out of cash. Oh, you can always add cash to your paper money accounts. Did you guys know that? If you need to have some more cash to work with in your paper money account, or you want to adjust it to the size of your portfolio you're working with, you can easily do that. That's kind of an aside, but I'll just show you here real quick. With let me just show you. You go to a trade that you've got on, do a right mouse click, and where did it go? Add cash, adjust cash right here. Wouldn't it be cool if you're a real account, you could do that? Whoosh, pop in an extra $1 million or whatever, right? That would be nice. Anyway, you can do that. Let's take a look first at Roblox. No, actually, let's do Roku. Let's do Roku. And I'm going to give you a little bit of a play-by-play as far as what happened here with Roku. We looked at this trade. We bought the 125 put, the 135 call. No, that's the other one. Roku. I did different strike prices. I apologize. And we did a 95, I think, a 100 call, and a 95 put. Okay, we got in earlier last week, and they didn't announce until Thursday night. Thursday night, Roku was down. And after hours trading, it was down like, I don't remember exactly how far. I recall at one time it was down as low as 8%. It might have gone lower than that. I'm not positive. And I thought, okay, looks like we're going to be glad that our put is there, that we're going to making some progress there. And the initial thought was whatever side loses we had a strangle on this, right? So we had long call, long put, different strike prices. And the expectation is on these trades, we're expecting a big move. We just don't know what direction. And so we played both directions on it. Well, the next morning, what happened? It did not open down. It actually opened up. And it had this enormous run. Okay. I'm going to go to a 1 day, 1 minute chart so you can see. So this is set up where the gray area is. That's the after hours or before hours trading time. So back last week on Friday, this was the before the market. And then I'm just going to kind of drill in here a little bit. Okay. And it just went pop, pop, pop. Went totally the opposite direction of what it had, how the market had reacted the night before. So you never can tell. I mean, it's nice to go to the pre-market or the post-market and see what the stock's doing, but it's not guaranteed to be there the next morning or do the same thing. So you have to be really aware of that. And so this thing went pop, 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 and was up pretty quickly, 13%, 15%, 16%. And we weren't even expecting that big of a move. I think we were expecting a 9% move. Okay, so it was doing way beyond that. Okay, so when it became evident that the bulls were really in charge, we closed down our call, or our put rather. Okay, held on to our call. We sold the put. We got a little bit of money out of it. We didn't get a ton out of it. We got We'll just look at the numbers here real quick. Go to activity and positions. So we're on our Roku. So we at 7:32, market opens here in Mountain Time Zone, 7:30. Options don't start trading till 7:31. So at 7:32, and it was pretty evident that's the direction that it looked like it was initially going to go, and it was pretty strong. That's why we sold that put, and we got 251 out of it. Okay, so not incredibly bad, right? Not a total loss for the put. We paid 620, so we were able to salvage a little bit out of it. And that's the idea. We expect one side to lose, one side to gain. And you typically are saying, all right, I'm going to switch over here now to my short-term trading rules. And so what we did is it ran up and ran up and ran up. It started to plateau here a little bit. Okay, you can see boom, 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 went up, went up, went up, kind of plateaued here, started to pull back. We were up about 16 point something %. So we went ahead and we sold our call at that time. Okay. One thing I was watching is I was watching to make sure that we could at least get something over our break even. 1285 was our break even because that's what we end up spending on the trade. Okay, for the call and the put. That's what we ended up spending. So here in terms of numbers, let's pull the calculator up here and let's go to the account statement. So 1285 is what we spent. So we take what we eventually sold that call for, 1325, plus whatever we salvaged out of the put. Let's run those numbers together here. Come back, calculator. All right, so 1325 plus 2.51, 1576. Okay, so 1576 is what we got out of it. And let's subtract that from 1285. So about 291. Now in these trades, because they're speculative in nature, and we're just typically doing one contract on them. Had we done more contracts, had we done, say, 2 contracts, maybe we might get out of one contract after the big move. And then maybe the other contract, you hold on to it for a little bit more time and see what could happen, because it actually went up higher. It went up higher than where we got out. Let's just go to a 3-month here. So I was watching it like a hawk. Okay, so about 116.66 was the high. We did not get out of the high, and don't ever plan. I shouldn't say don't ever. It's hard to peg that top. Okay, but it kept running for a while, and so it did. It went up higher than where we went out. So did we leave a little bit? Yeah, we did. But man, you get a 16% move, 15% move, you're like, oh, this is good. Let's pay attention. It could go a little bit more or it doesn't. And sometimes it'll fade just like it did on Friday. So I was happy where we got out on that. Now I'm going to look at the chat and see if any of you paper traded that with me. Okay, Momo has a question there. I might entertain that in just a minute, just a little bit about explanation of those columns. Paul says, can we pull back to a macro view of what we were doing? So yeah, on the 3-month chart, okay, Monday was our class, and that was the, let's see, the 27th, I guess it was, okay? So that's when we got into the trade. We had seen earnings were coming up. We wanted to get in before the earnings announcement. And we were looking for a big move, and we'll go through that process here again today as we look at some new examples, okay? So the idea here was we are expecting a big move because the stock has moved really big in the past over earnings, okay? Let's show you real quick our Roblox trade. And this is going to be interesting here as well. Our KLB. Oh, nope. It's a RBLX, Roblox. Here we go. Here's Roblox. Same thing. We bought it last Monday, expecting a big move. We knew earnings were coming. We didn't know what direction it was going to go, and we were working on our strangles last week. So we bought an out of the money call and out of the money put. Okay. Well, in this case, what happened? Man, that stock gapped down quite a bit, and then it kept running. To be honest with you, I kind of forgot that it was going on. And I didn't sell the put as soon as I should have. If I had been watching it like a hawk, like I was on Roku, we would have been able to get out sooner and salvage a little bit more out of it. When I finally sold the put, or the call rather, we held on to the put. The call that we sold, we only got $1.58 out of. So it's kind of like, oh yeah, we should have been paying attention. But then this is what I did as far as the management of it. I said, okay, we paid $18 net debit on this trade. We sold the put or the call for $1.58. So I said, well, we need the put value. What we'd like is to have it be, above 1642, because 1642 is now our break-even point. Okay, for what we spent, what we sold the call for. And so what I did is I've been watching it here. It's been dropping. This day was kind of a little bit all over the place. Today, down again significantly, 5.33%. So that's really helping us here. I'm going to go over to the monitor tab, and we're going to go to the activity and positions because I want you to see the working orders. So on this, I've got our put in there, and I said, if we got out at $20, we'd be happy campers. Okay. Finally, today, we're beyond our break even. Finally, at this point, it's an unrealized gain because we haven't done anything with it. Okay. But now we could sell that put for $17.90. okay, which is pretty close to our net debit of 18 bucks, okay? So now we're finally seeing a little bit more of the positive side. Now, one thing I wanted to emphasize to you was our time that we bought. We went out to November 21 on this so that we could have some time, especially, I'm so glad this played out this way so you could see it. If you need the stock to have a little bit more time to move so that you can make money in it. Had we just gone with the options that expire on Friday, we would not be in a positive position. Okay. We would have not met our break even point. We would have closed a little bit lower because you can see it's down $6.36 today. That's $6 that we didn't have on Friday. All right. Any questions on this trade? Ricebird, it's okay that you missed Monday. We've got it recorded. You can go back and take a look at that if you want to. Is it possible to do a conditional order on that strangle? Absolutely. Absolutely it is. And maybe we could even show that maybe in one of our, I'll show you a little bit on one of our new trades from today. Okay, so happy with how these played out, really giving us experience. Okay, what do we do now? Do we have enough of a gain that we're happy with it? We basically cover our cost, and we got, except for 10 cents worth, we got a 158 out of the call that we sold. So we only have basically 148-ish, not counting commission in the profits. So we could continue to let it drop. We could watch it, or we could say, all right, let's leave our $20 target on it, see if it drops a little bit more, just to 20 bucks. That's a little bit better gain on the trade, right? Then we're sitting at like 158 plus, say if we get 2 more bucks out of it, then we're looking at 300 or so as far as a gain. All right. So if we wanted to put a condition on this, I'm basing this off the price of the option, the $20. But if you wanted to say, okay, if the stock gets down to, say it drops 2 more bucks, right now it's at 107. If you said, hey, if it drops to 105.50, you could put that in as a conditional order as well. I'm going to show you what it would look like. We won't put this through, but we'll do a cancel replace this trade. We wouldn't know what the price of the option would be at that point, so we'd change it to a market order. And then we'd come over here, click on this gear on the far right. And then on this gear, we could say, all right, if Roblox gets less than or equal to, I think I said 105.50, would be another $2 down from where it is right now. So if it's less than or equal to 105 for that market order, we don't know what the price would be. It can't be guaranteed. It's just fill us at the next available rate. Okay, so that's how you could put a conditional order on that. You absolutely could do that from the get-go as well. Now, I'm not going to change our order that, but I just wanted to show you how you could do that to answer that question. Okay. So the 7:32 on the time frame is, I have it set to my time zone so I can keep track of it. So the market opens at 7:30 in my time zone. So if you're on the East Coast, that's really 9:30. If you're on the West Coast, it's really a little bit earlier. It's about 6:30. Okay. Yeah. So you'll have to make some of those adjustments according to, you know, your time wherever you happen to be residing. Brett and I are in the Mountain Time Zone. Okay. I think we've caught the questions mostly, except for the one about, you know, what are we seeing on the chart? Basically, just in a nutshell here, because we can see these two positions. P&L open is basically, what has the position done since we opened it? Are we up on it or are we down on it? P&L day tells us what's happening today. So on this hood trade, we're down 30 bucks so far today. But overall on the trade, we're up $270. And so these are kind of key columns that people will keep track of and should always be on your screen for the most part, okay? Those are going to be defaults, and it's important that we keep them because that's actually what we need to know. All right, next up, got some more earnings this week. Straddles and strangles, when we're long, typically are better for really big moves. How do we know if a stock's moved really big? Well, you see what it's done in the past. We're going to look at here, our first one we're going to look at is Affirm, AFRM. These guys do, you probably have seen these. You go out and you buy something online and it says, hey, do you want to pay for this over 4 periods? It'll only cost you this much. And this is one of those companies that does financing that way. So if we come out here to the last year and we say, okay, has this stock moved that much over earnings? Let's go to clear to the far left. When it had earnings here, it had a little bit of a gap up. Well, let's see. Here's our a little bit, I guess. Let's see. This one was, let me get down on the earnings. So they announced this night after the close, 11/7. So the reaction was what happened the next day. Didn't gap a tremendous amount. I mean, it gapped a little bit, dropped, and then it didn't stay down for that long. So that particular move, not so big. Let's check the next move. Next earnings, closed here, opened up here, big gap up, and then it continued to run, and then it continued to run after that. It's not guaranteed to continue to run, even if it gaps up, right? It's never, nothing is ever guaranteed. Okay, let's see the next earnings period. All right, the next earnings period was they closed here about 54. The next morning, it opened at $50.50. So it dropped basically 150. Yap continued to drop that day. But what happened the next day? Popped right back up. Okay, so we don't really know always how the market's going to react. And so now the most recent earnings was back here. Huge gap up, huge run up to 100. And look at this. It hasn't come back to 100 since then. So sometimes when we see these really extreme moves and we're able to see it and catch it, and you're like, you know what, that's a good move, you might consider just shutting your trade down, taking your profits, being on your way. Because there's no guarantee that it's going to stay there or even get back there. And you can see on this stock, it didn't. Back the next day after hitting that 100 high, it closed at 82. You would be so incredibly disappointed if you're sitting up here at 90. You're like, oh, I could take it, but maybe I'll just see if it goes further, right? And then it comes and closes down here at 82 the next day. Now, you might be a little disappointed on that. I'm just guessing, all right? Now, so these guys announced their earnings will come out here on the 6th, which is Thursday after the market closes. We'll expect implied volatility. This is kind of interesting, just kind of, there's not like a steady gain on the implied volatility that we see sometimes as a stock goes into earnings. We're going out a little bit in time here before they announce. So implied volatility is already a little bit high. Okay, market maker move, you guys. This is something we're going to use in this class all the time. And I moved it so it was up on top. So any of you that maybe don't have the market maker move, I'm going to share this with you and then I'll tell you what it means. Market maker move comes from the trade tab. And I'll just switch over here real quick on Affirm. And it's this little area right here where you see yellow and it's saying plus or minus $9.05 is what the markets have priced in that they're expecting on this move for whatever the event is. In this case, the event is earnings. Okay, so you can see $9.08. Right now, they've priced in a 12% move. Now you think about a one-day move on a stock, 12+% is pretty big. So they are expecting a big move. Do we think the options might be expensive then? Yeah, they might be quite expensive. And we'll go to back to the trade tab and talk about that. But see this yellow line here, that is showing us on the chart what that market maker move is expected to be. And it's based over here. We see it listed here again, so we can know. And it's just reflecting the same information that's on the trade tab. Okay, so let's see. Did I post that out there? Yeah, I guess I did. Remember on scripts that we share with you, they're never guaranteed as to accuracy or timing, which means there could be a flaw in there somewhere. But most of the time we're using these scripts quite a bit, and they're just helpful little calculations. All right. A question came up last week that I kind of want to address here. And somebody said, if implied volatility is so high, why are we doing a buying strategy? Last week we were doing strangles, out of the money call, out of the money put. They're like, wouldn't we want to be a seller? We could potentially sell a short straddle or a short strangle, but typically people are going to use those when they're not expecting huge moves. Okay, because if you have say a call that's short, you have theoretical unlimited risk on a short call. On a short put, it is limited, but it could be a chunk of change, and it just basically says, if the stock were to go to zero, this is how much theoretically is at risk. And so if it goes past that, you could really do a disservice. So people, if they want to be doing a selling strategy, typically might put it in a spread. Okay, whether they do an iron condor, short vertical of one side or the other, or long vertical, where they're taking advantage of that. But since that's not our class, we don't do verticals in this class. We do straddles and strangles. Okay, so we'll put forth what we could potentially do here. So come over here with me to the trade tab. We have some weeklies. Okay, so these are the options that would expire on Friday. So they would announce Thursday night, and we would have this one day after the announcement to have the stock move sufficiently for us. Had we done that in Roblox, we'd be at a losing trade right now, right? Because if it expired Friday and it wasn't near our break even, so we would have lost money. Up here, these numbers, like this 162.94%, tells us how much implied volatility is priced into the at the money options. And this number is plus or minus by Friday expiration $10.24, either up or down. We don't know the direction, right? It's pretty close to this $9 and change. This one is just taking into account one extra day. Okay, so this is for the event of earnings, and then this is for all the way till Friday when the option closes. Okay, now as we go out a little further in time, usually it's not quite so high. Okay, so 162 here. The next week out drops to 116%. So still pretty, obviously both these numbers are high, but definitely back down, what, maybe 40 something percent from what's priced in here. And then we get out to say November 21, it drops another few percentage points down to about 103. If we went out even further in time, November 28, it drops down to about 93. Now, those are still expensive options, okay? But not as much as maybe if we were working only with the weeklies, okay? John is asking about the difference between verticals and straddles and strangles. Okay, so straddle is buying at the money, call and put. We're looking at a firm. The at the money here price is $72.68 right now, so $72.50 would be our at the money. If we're doing a straddle, we'd buy one of each, a call and a put at $72.50. If we wanted to do a strangle, it means we're buying options out of the money. Okay. And it doesn't have to be just one strike out of the money. You can decide how far you want to go out of the money. What does that do? Well, the further we go out of the money on these puts, notice the premium gets a little bit smaller and a little bit smaller. So it doesn't cost as much. But when we're calculating our break even, we're basing it off of the strike price. And so, what's 71 minus 565? Oh, we need the stock to drop down that much in order to break even. On the call side, it would be out of the money this way and would be adding to the value. Okay, so you kind of are deciding, if you're doing a straddle or a strangle, kind of like, well, if I want a lower break even and pay higher for it now, or do I want a higher break even and maybe not pay as much for it? Okay, so you're just kind of weighing those out, and there's not a magic question to answer which one's better or worse. You just get to decide. A vertical is we're definitely selling something. Okay, John, we're doing a short put vertical where we're selling a strike and buying an out of the money further strike for, say, a short put vertical, and just the opposite on a call vertical. selling out of the money and then going a little bit further out of the money many times for that option. So a spread, you're going to be buying and selling. Okay. Yeah, if you were to put them together on the risk profile graph, which sometimes we do, then you can definitely see the difference. That's a great comment there, Paul. Appreciate that. Okay. So let's look here. I've got open interest. We've got decent open interest here. We're going to go a little bit further out so that we're not boxed into a corner. So we have a little bit more time, and we can even go up further in time if we wanted. Go out a little bit further in time so that if the stock takes a while to make the move that maybe it's indicated it might do after earnings, like Roblox, that we have the time available to do that. Okay. 7250 is going to be our at the money. We have decent open interest here on the put side, on the call side as well. So sometimes that might help you make your decision. Should I do a straddle or a strangle? If you have great open interest at the straddle, but you don't at the strangle, you might go, okay, we're just going to go for the straddle. It could also be vice versa. You have more open interest to an area you think the stock might go, then you could do something out of the money. All right. On this one, we're just going to do the at the money. We're going to do a straddle. We're going to buy one call. We're going to buy one put. And one thing you'll notice sometimes is that often it gets kind of close, whatever that premium is, gets kind of close to the expected move, but not entirely, okay? Because this is just for an event and priced into the options is definitely till options expiration, okay? So let's go ahead and I'm going to queue this up. I'm going to hold down my control key. You could do it that way and click on the ask price for the put. We're going to do the same thing on the call. And so we're going to spend just in the short of $13 on this trade. Let's see, interesting here. They are almost exactly the same here, 680 and 680. Interesting. Kind of heavily or evenly weighted, which sometimes we don't get. Sometimes you're paying a little bit more for the put or a little bit more for the call. But it is kind of nice when they're fairly similar to each other. So 685, nice. That's what we're going to do. All right, let's go ahead. In this case, we're going to do two contracts. The reason we're going to do two contracts is because we might, if we have the opportunity, if we get a big pop or a big drop one direction, and we say, okay, let's gather. Let's get some of that gain, should it be a gain, and give the stock a little bit more time to drop by having that second contract or to continue to go up. Okay, just kind of gives you a little bit more options if, and you have to make sure that it's appropriate for your account size. Okay, we definitely want to make sure of that. This particular strategy, straddles and strangles, when you have really expensive stocks, they can be really difficult for you to participate in the trade because it's so expensive. And some of you don't have these enormous accounts. Some of you are trying to like build up your accounts. So we're going to go ahead. We're going to hit confirm and send here. We are going to put this in our straddles and strangles grouping. We're going to send it on the way. Now, I was giving you an example of, I'll give you an example here of one that I chose not to do because the stock was so expensive. Here's AppLovin. Okay. It's expected to move, the market maker move is expecting it to move $68. And we have 143% implied volatility priced into those front week options. Okay. Super expensive. We come down here to look at, say, the at the money, which probably is going to be what at this $625. You know, $51 for the contract, $49. These are really expensive contracts. Because it probably doesn't apply to a lot of you, I thought I'm just going to skip this. Let's use some numbers that maybe are a little bit more realistic for most people's accounts, because that certainly is a consideration. So here's another one here. Let's go to SMCI. Okay, microcomputer. They are about a $50-ish stock, so premiums are going to be a lot more reasonable simply because the price of the stock is more, you know, a lower price stock. But it has enormous implied volatility priced into there, and the market's expecting a $4.84 move. We look at that on our market maker move, it's about 9.29%, so still pretty big mover. If you go back and look at the previous earnings, we can see, oh, this one gapped. Well, actually, this one might have stayed sideways for a little bit, or maybe they changed the date they were announcing. Looks like maybe here is when they announced, and it looked like maybe it didn't do a whole lot on that initial one. Took a while to kick in, unless this is off, but this one we can see big gap up here. This one we can see huge gap down. So you see the history that, okay, this stock moves, maybe it makes sense that the market is pricing in a big move here. Again, we don't know which way. Let's go back to our options here. So we could do long options or short options. We're going with the long side of things because we're expecting the big move. We're expecting, yeah, we're buying high implied volatility. We're doing some things to try to minimize kind of what we're paying for it by going out in time a little bit. So having 103% priced in versus 139% priced in at the money, and giving ourselves time, because these guys, they're a little bit later in the week too. Looks, I think they're 11/4, so they are tomorrow after the market closes. Okay, so somebody wanted to be real aggressive, yeah, you could go in this front week. Okay, but then you don't have some additional time should it need it. So we're going to go with the November 21s here as well. And 52 would be our at the money strike. We're going to do a strangle. So 52s are at the money. If we were going to do the straddle, it would be this one. If we do the strangle, it's going to be this one. Want you to know some of these have enormous open interest out here. Okay, so 52's at the money. So we're going to go with the 51. I love those 2,000 contracts out there. And hold down my control key. And then on the call side, we're going to do the same thing. We're going to go one out of the money. We're going to go to 52. No, we're going to go to 53. Definitely plenty of open interest here. There's a ton in the 52s, the at the money. All right, but we're going to go ahead, 53. So about 745 for both of those. Same thing. We're going to do 2 contracts. Anytime we're talking about these contracts and we're talking about cost or net debit, we're not including the commissions and fees, right? Which for contract are going to be charged per fee. All right, so about 743 for the total net debit on this. Now, the market is expecting a move of 480. Man, we want it to go at least 480 because we take this 745 and from a perspective of saying we're probably going to lose one or the other. Okay, hopefully it'll move big enough that it means the put was impressive or the call was impressive. We go sell the losing side fairly quickly after we can ascertain that. And then hopefully we get a continued big move down on the option that we keep. All right, now going back to a question here, it says, could we put in conditions? Certainly we could put in conditions. Okay, so for example, if we wanted to add 745 to the strike price, say on the 53, if we wanted to add 745 to that, because we know that's near our break even, we could say, all right, we want to sell this if it gets $53 plus 745, so in the neighborhood of about $60.45. And you could put that over here using the gear. We're not going to do that because I want to be able to use my discretion on it. And sometimes it doesn't move quickly. Sometimes it sits there for a few days and you're like, okay, it's time to move. And implied volatility comes crushing out. So you're sitting there with those long options. Implied volatilities come crushing out. And you're sitting there with 2 losers for a while. Sometimes that can happen. And so you're waiting for it to just tell us where you're going to go. And there could be times it doesn't go anywhere and it just sits there flat for a few days. Okay, that'll be frustrating on a trade like this, which is why we want to see the history that typically it moves, and that it moves big. Okay, all right, we are going to send this over to our straddles and strangles bucket. All right, now it looks like we have a survey out in the chat. And you guys know this from time to time. We'll put out a survey here. I don't control it, nor does Brent, but the idea is to see, how this particular session today is going for you. We're about ready to wrap up, so you know the majority of the content that we went through here today. So it's 2 easy questions, and you just put in the radio button, fill it in, plop, plop, you're done, right? Take 2 seconds. There are 2 questions you can answer if you want to, which I love it when you do answer those questions. If you have some things you're like, yeah, I'd like you to cover this, or you could use it to say, hey, Connie, could you talk about this particular thing in a future class? And I love to incorporate your questions into coming sessions so that we can discuss them, because probably somebody else has that question too, or is facing the same issue. All right. So if you'll do that for us, I promise I will read every word that you write down, and our managers do as well. All right. If you want to paper trade these along with me, I think it's a fabulous idea in your paper account, right? That's where you practice. That's where you get a comfort level with different strategies. And if you do a few paper trades of this strategy and you're like, I don't think this one is for me, I don't like these speculative trades, then it might not be one of your go-tos. Maybe you only use it occasionally, but at least you understand it. And you could decide, if there are situations when you might want to employ it, but if it doesn't turn out to be your favorite strategy, it's okay. It will not hurt my feelings whatsoever. Okay, but because it is more speculation based versus higher probability based, and some people feel more comfortable with higher probabilities. Now, I hope you're a subscriber to our Trader Talks channel. When you are, it makes it so much easier to find our content. And let's see, if we come over here, you'd see Trader Talks, the channel, Schwab Coaching Webcasts. You can see what's coming up. So after me, Barb Armstrong is going to be teaching trading a smaller account. She's next on deck. And then after that, James Boyd with trading with technical indicators. I think well, no, I won't be in the chat on that one. Okay. But you can see what's going on. If you want to make sure you're not going to miss that class, just send me a little notification. Let me know about it. And then we have some different watch lists or playlists for you, rather. And you can go into the playlist for the classes of what you might be looking for. Like, let's see, what is your name here? Mr. Birdman. I forgot your first name on this one. Whoever is the Birdman said, oh, I missed that last week. You could go back, find the watch list, Straddles and Strangles right here. Here's the playlist. You can go in, watch that class, and be up to date. All right. Any additional questions that I have not addressed, let me know. My other ask of you is, if this was helpful to you today, hit the like button on the way out. That lets other traders know you found the information useful and helpful. And it adjusts the algorithm so that it helps them find our content easier as well. It seems like there was one question here real quick. Charles says, what about a cheat sheet for the criteria for straddles or strangles? If I were to give you a cheat sheet, I would say a couple of keys. Let me go back to here. 1, does it have a history of moving big? Okay. You can go back, you can look over the last couple of years. Does it move? And sometimes there are stocks that moved really good in the past that aren't moving as much now. So you say, okay, last year, last 2 years, do we see big gaps? That's an indication that, yeah, it's a bigger mover. The other thing is looking at the market maker move, the implied volatility priced in here. The higher this number, the more is priced into that. So the bigger the expectations of a big move. So you're like, well, I'm not sure what small, medium, large is. I would say small is like 2, 3, 4%. Medium's like 5, 6, 7, 8%. Then you get to maybe something higher, 9. One of ours today was 11. I think our first trade on a firm was over 11% priced into the market maker move. And so probably classify that a little bit more as a high big mover. Okay. So look for those couple of things on the charts. We're not really concerned about getting in at a particular point. We're simply doing it for the earnings trade. Do you have to get in earlier in the week? You don't. You could get in the minute before the market closes and it announces, and 2 minutes later. You could do it late as that. So you can time when it's appropriate for you to get in or what you're willing to do. Sometimes implied volatility will ramp up during the week. So it could be that we get to the end of the week, and I've seen this happen before, where both the options are positive because implied volatility went up and impacted both of them. Okay, so that's why we paper trade it. We do it, follow along on these example trades so you can get a feel for it. All right, you guys have been great. Brent, thank you so much for your help. We always have lots of questions here. Skylo says, did I send the market maker move out? I did. I did put that into the chat. For those of you that, let me, I'll put it also in my notes for the class. All right, if you didn't catch it earlier when I posted it, you'll see it in the chat or in the notes as well. So you guys take a little break, get some refreshed beverage, and Barbara Armstrong will be back with trading a smaller account right at the top of the hour. I'm looking forward to a couple more exciting trades to watch this week. Okay, you guys, we'll see you then. Bye-bye.